Welcome to Global Tax Talks Tax in 60 Seconds. I'm Will Morris, and here are some things to watch out for in the coming week. So, another week and another couple of executive orders from the White House in Washington continue to dominate the news. I was in Canada last week, and this was all that businesses wanted to talk about. Well, that and a certain ice hockey game where Canada beat the US. Anyway, the most recent EOs, both issued on February 21st, circle back to DSTs, but there's also a renewed focus on China, including on tax, that's worth noting. So, first to the DST EO, issued, as it says, to protect US companies from foreign-imposed taxes, fines, and regulatory restrictions. Now, this obviously includes DSTs, although it talks about all taxes, which could go much broader. UTPRs, certainly, but perhaps also equalization levies, significant economic present tests, etc. In relation to DSTs, it mentions reopening the Section 301 investigations, first done in 2019, involving France, the UK, etc., and mentions Canada, both in relation to a panel under the Free Trade Agreement and a possible Section 301 investigation. But the tax angle goes beyond DSTs, raising again the spectre of Section 891, particularly in reference to the digital economy. Now remember, this is the existing US provision that allows the doubling of tax where there are determined to be discriminatory or extraterritorial taxes. And beyond that, it calls for a permanent moratorium on customs duties on electronic transmissions, which the Biden administration was rather lukewarm on. And it also goes beyond tax to call for reports on foreign regulations that limit US companies' operations or restrict free speech, how they interact with consumers, and so on. In other words, this executive order is incredibly wide and needs to be read in full. One of the questions I got asked last week by the businesses I saw was, should we take this just seriously or also literally? I think the answer is both seriously and literally. Trade skepticism has been part of President Trump's worldview for decades and is his core belief. And this executive order, perhaps more than the others, shows that there is a coordinated approach here. On their own terms, these actions are being proposed in order to make the US a more attractive place to invest, to remove the advantages that other countries and their businesses are perceived to have gained, and also to support key US industries overseas, including the tech sector. I think this is a sea change, a real tipping point. All of these EOs act consistently together to promote a much more muscular trade policy. And us tax folks have to understand that tax is an integral part of this, but not because it's tax as such, but because tax is seen as a crucial element of competitiveness in this upcoming trade battle. To some considerable extent, we, tax people, will need to change the way we think about tax. Now, just very briefly on China, the other February 21st executive order lists a number of actions to be taken against China, and amongst those is an instruction to consider whether the US-China tax treaty should be suspended or annulled. Again, not because it is offensive on tax grounds, but because it gives China an advantage in attracting US investment. Anyway, thanks for joining me, and come back next week so that you stay global tax ready.